It's the year 2000 and your life is going great. Nothing can be better. You've got a great job, the economy is booming, and some of the best games to ever come out this decade are glued to your PlayStation and Game Boy. There's just one thing missing though. You've got all this money sat in your bank and your friends are all saying that you've got to get invested in the stock market. They're making a killing out there, so you don't want to miss out. So you finally get around to setting up your investing account, pull together all of your savings, check down the back of the sofa and get all of the money over to your broker who says it's never been a better time to invest.
You make the news, the girls will be all over you.
Turns out as well, you don't even need to pick stocks. You can just invest in this thing called an index fund, so you'll own the whole stock market. So you place your order, get your trade in, and now you can relax. You can go back to playing Tony Hawk's Pro Skater because you really need to nail that 1080. After a couple of months, you're already up in the green and making money. I mean, what a great start to the new millennium. Then around March of 2000, things start to take a bit of a turn. The Nasdaq actually has one of its worst ever single days, losing almost 10% in April of 2000.
It was the worst single day point loss ever for both exchanges.
And then it's pretty much a slow bleed from there.
It's really fueled by what you would call the greater fool theory. In other words, it has to be a greater fool than you that buys it, or the whole thing collapses. Well, ultimately, you run out of greater fools.
You're not going to sell though, you're committed now and your broker is telling you that everything will be okay and things will be back to normal very soon. But the weeks and months roll on and your top score is definitely improving on Tony Hawk's Pro Skater. You're not bothered about listening to the doom and gloom on the news anymore. It's just one bust after another with all of those internet companies who are set to change the world collapsing like a house of cards. Down and down the market falls until it finally bottoms after almost 2 years, which puts your account down almost 50% from where you started. So much for investing. Now, it's up to you. Do you sell everything and pull out and walk away with your tail between your legs, or do you just keep holding on? But what if the market keeps falling? Isn't it just your luck that the market falls as soon as you invest? Well, clearly in this example, this person is very unlucky, and luck definitely plays a big part in investing. But what if there was a hack to become luckier with your investing, and almost anyone could use it? What if there was an infinite cheat code where you couldn't fall off that skateboard, you never get hit by Bowser, and you always get the golden gun and player's odd job on the N64? And just for the record, when we were playing multiplayer, we banned odd job because you couldn't get a headshot unless you aimed down and you had to use those C buttons. If you know, you know. Anyway, I'd be lying if there was an infinite money cheat, but why don't we call it a power-up for investors, the same as picking up a mushroom, getting that one up, and finally being able to shoot flaming meatballs from our hands. Now, I know that's all a bit much, but you have to make investing exciting, otherwise it can get boring very, very quickly. So let's just step back a bit and consider the issue here. In our 2000s example here, our investor lump summed everything into the market at once, which we're often told is the best thing to do. In fact, there are loads of stats which back this up, where most of the time, we shouldn't bother messing around trying to time the market. Instead, just get the money we have and throw it all in. And let me just show you why this is one of the best strategies, at least most of the time. And I'm going to take a lot of this data from a book called Just Keep Buying from Nick Maguilli. It's well worth a read. So in the section around investing and when to invest, Nick's asked the question, is it best to just lump sum our money in or gradually put it in? Say if we had £12,000 or dollars and did $1,000 a month, or just put everything in the market at once. As you can see, the results are pretty conclusive, and this shows that even as far back from the 1960s, every time you fall below this middle line, it shows that dollar cost averaging underperforms just doing a lump sum investment over 24-month rolling periods. Pretty much an open and shut case that shows doing lump sum investing will win most of the time, unless of course you happen to lump sum just before a big crash, and although they're rare, they are part of that market cycle. But just before you think you've got this one all sewn up, that's not the cheat code, because let's be honest, this is nothing like real life. When do you only invest at one point in time and never touch the stock market again? You don't start this game with a bag of coins, you have to earn them as you work your job or make money in your business. So us mere mortals play a different game, because technically if you invest each month from your paycheck, then you are lump summing into the market, as that's all of the cash that you have at that point. And then as each month passes, you're doing the same thing and getting the best of both worlds. You're buying on the way down and on the way up, and you're reducing the risk that even a bad market crash will leave an effect on you. One point that Nick makes here is quite interesting. Let me just read you this bit on his final summary on this chapter. He says, when deciding between investing all your money now or over time, it is almost always better to invest it now. This is true across all asset classes, time periods, and nearly all valuation regimes. Generally, the longer you wait to deploy your capital, the worse off you will be. Now here's the interesting part, listen up. I say generally because the only time when you're better off by averaging in over time is while the market is crashing. However, it is precisely when the market is crashing that you'll be the least enthusiastic to invest. That last part I think is really important because I do see a lot of comments across the YouTube finance community that says they're hoarding cash ready for the next leg down, or that they've stopped investing right now because they know things are going to get worse because somehow they're experts at predicting the stock market. I think we've all seen how over the last 12 months in the investing world, just what can happen in a short space of time and how fast a sentiment can change from buy the dip to I'm never investing again or selling everything and waiting in cash. And let's not forget that I'm just talking about the wider stock market here. If we're talking about individual companies and stocks, we're now in a whole different minefield that really is the Wild West where anything can happen. And unlike the stock market, individual companies don't have to come back. So the cheat code to unlimited stock returns is to avoid crashes and suddenly be able to know when the bottom of the market is, right? And if I gave you that superpower, you'd be unstoppable and you'd just beat any normal investor to pieces, right? Well, rather than just say that, why don't we put this to the test? And this is another credit to Nick. Here are the rules. I'm going to drop you somewhere in history between 1920 and 1980, and you have about 40 years to invest in the stock market. You can choose two routes, but because I'm just speaking to a camera and you can't talk back to me, I'm going to give you the best option, don't worry. Kind of like how when you played computer games back in the day, you always gave your best mate the official controller, and then you played with the one that your mum got you from Argos. You know, the Mad Catz one with the sticky buttons. Alright, that never happened. You always used the official one or you'd throw a temper tantrum. Anyway, where were we? Right, somewhere in the stock market in history, and here's the options. You can invest $100 or £100 every month for 25 to 30 years, no thought at all, just kind of like pressing the jump button and hoping for the best. And option 2, which I'm kindly giving you, you are welcome by the way, where you get to buy every single dip. And because we're giving you the God cheat code, you buy every dip right at the bottom, so you save your money each month until there's a dip, so no buying at all-time highs. You may as well just start picking out the colour of your Lambo now. Are you more of a bright orange guy or more of a bright green one? Let's run the numbers anyway, just to see how much you're going to beat me. I'm not looking forward to this, to be honest. So I'll have to buy each month no matter what, but let me show you where you make your buys. We're starting in 1995, by the way, so we get 2 juicy crashes, so that's no excuse at all. Here's the data from Nick's website so we can actually see it when compared to the black and white chart in the book. Here are all the new all-time highs from 1995 to around 2020. So I'm going to have to buy anyway, but you'll save up your cash while those take place and make some big purchases once we hit rock bottom. So now let me show you where you'll be buying. If we add in the dips, here are the red dots now added to the chart for you. And the best thing about your buying is that you've saved your $100 each month ready for those dips. I bet you can't wait to see how far ahead you're going to be. So let me show you this next chart, which is actually a better show of when you actually buy and your cash pile. You can see that between the crash of the dot-com bubble and after the financial crisis, you pretty much save it all and then go boom, just when the market hits a bottom, and then you reset again, saving those $100 bills nicely until the next dip, and so on and so on. Aren't you lucky? Then poor old me has to buy no matter what. You've got to feel sorry for me a little bit, and I hope you're going to give me some of those juicy profits. Shall we see the results? Well, let's pop them up on screen now. This is going to be pretty embarrassing, isn't it? Alright, here goes. Where's that it? So let me get this straight. After all of your amazing dip buying, you only beat me by just a little bit. My dollar cost averaging through all of the pain gets me really close to even the best possible market timing. Well, isn't that disappointing for you? You're never coming round to my house again to play GoldenEye. Now, what's interesting here on those results is that during this time period, it's just a couple of those buys that you made that made all of the difference, and especially the big one after the great financial crash. Because as you know, that amount of money snowballed to become a lot more later on with compounding. And let's not forget about dividends being reinvested too, and that's another reason why I stayed so close to you. As even in bad times, my money was growing and still reinvesting those dividends, whereas you had all of your cash ready but weren't generating anything with it. And speaking of generating returns, if you've enjoyed my attempts to combine 90s and noughties gaming references with investing, please do me a huge favour, hit the like button below, make sure you subscribe too, it does really help out small channels like mine, and thank you so much for the support. And just before you take all of your returns, let me cherry pick just for a moment to show you something really interesting that Nick highlights on his blog post. If we started out investing in 1975 instead and did the exact same strategies, you'll never believe this, but the dollar cost averager actually comes out on top. None of your market timing can beat me because after all, my money's in the market getting me dividends and compounding year after year, even through all the ups and downs, because over that long time period, the compounding beats even your great timing. And that's mainly because that old money that's been in there the longest gets the chance to grow to some really impressive returns. So is that the ultimate investing cheat code? Well, I think it's as close as you'll get, because unfortunately we don't know the future. We've got no idea if we're going to enter a period where we don't get to new all-time highs for a decade, what interest rates will be, if we've seen the back of inflation yet, or if the world's about to head into a long recession. All we can say is if we invest for a long time, fight the urge to time the market, invest in a way that suits our needs and our own risks, we make ourselves the luckiest we can be. Sometimes that luck is great, and then sometimes it's just okay. In fact, let me show you some results from the past from more of Nick's data. Now, the best 40-year period fell from 1922 to 1961, and that gets you more than $500,000, even adjusting for inflation. But the worst period of 40 years, which was 1942 to 1981, only gets us $153,000. Now that's a pretty huge difference, isn't it, between two people's lives, but then there's not much else you can really do to avoid that. All I would say is that this is just the stock market, and there's so many more things that you can do outside of it that are in your control. Like, for example, how much you contribute really is one of the biggest factors. And also, let's not forget about fees and charges. And what about taxes as well? And is this a tax-free investing account, or are we liable once we need to draw money on? Anyway, you can see how it gets really complicated. On that note, if you are looking for a guide to help you get started investing from the beginning, I've made a completely new video here for beginners updated for 2023, taking you through step by step everything you need to know. Otherwise, you can watch this next video while I make a fool of myself trying to make it look like I've gone down one of Mario's green pipes. I really hope this goes well. Either way, happy investing. Here goes.